Okay, think about this. Surging home prices, the future of Social Security, and get this, Sydney Sweeney's latest denim campaign. Seems like a weird mix, right?
Huh, it does sound a bit random, yeah.
But today, in this deep dive, we're actually going to connect those dots. We've sifted through a ton of the latest news and research, all tailored for you.
Exactly. Our mission here is simple. Cut through all that noise out there, pull out the really crucial bits of info, and, link these things together across different areas.
Sort of a shortcut to really understanding what's going on.
That's the idea, a shortcut to being genuinely well-informed.
And we mean genuinely well-informed, because this stuff is fresh. We're talking financial reports, market analysis, new policy ideas, tech news, even some human interest stories that popped up.
All published today, July 24th, 2025.
Okay, so where should we start? Maybe the economy, how it's hitting people's wallets.
Sounds good. Let's take the pulse there. How are these market forces, these new policies, really affecting folks financially?
Right. And you almost have to start with housing. It's been such a paradox lately. What's the latest data telling us?
Well, it's pretty striking. The median U.S. home price, it hit another record in June, $435,300.
Wow.
Another record.
Yeah, that's up 2% from last year, and it marks 24 straight months of prices going up. 2 full years.
Okay, but here's the paradox, right? Because even with those record prices, sales of existing homes actually fell 2.7% last month.
That's right.
And they're on track for the slowest sales year in, 30 years, since 1995.
Exactly, since 1995.
So how does that work? Record prices, but hardly anyone's buying.
It's a classic sign of, well, market imbalance. The big problem is just lack of supply, especially for first-time buyers.
Right, not enough homes on the market.
Not nearly enough. And then you layer on the high mortgage rates. The 30-year fixed averaged 6.74% this week, according to Freddie Mac. Still quite high.
Yeah.
So while the prices people are paying are rising, especially at the top end, listing prices overall have been kind of flat.
Ah, okay, so it's splitting. It seems like it. Wealthier buyers are still managing to buy the higher-priced homes, but, first-time buyers, people looking at the lower or middle parts of the market, they're getting priced out.
That makes sense. A tough picture. So any relief in sight? Anything happening on the policy front to maybe boost supply?
Well, there is something interesting, a new bipartisan bill. It's called the SUPP All-Y Act.
Okay.
And it's aimed at making it easier to finance accessory dwelling units, ADUs.
Ah, the granny flats or backyard cottages. We hear a lot about those.
Exactly. So what this bill would do is authorize FHA insurance, that's the government backing, basically for second mortgages, just for building these ADUs.
Okay.
And it would let Fannie Mae and Freddie Mac buy these loans too. So it's really trying to fix that financing gap that stops a lot of, lower and middle income homeowners from building one right now.
That could definitely help unlock some potential. But wait, does it actually change the local rules, the zoning stuff?
No, that's the catch.
Because that's often the biggest hurdle, isn't it? Minimum lot sizes, rules about who has to live there, crazy high fees.
You're absolutely right. The bill doesn't touch state or local zoning, and those are still, as you said, often the biggest barrier.
So how much difference can easier financing make if you still can't legally build it?
That's a fair question. Federal policy can only do so much without local cooperation. But we do have a pretty good example from California.
Oh, yeah. What happened there?
Well, they made some big reforms, got rid of owner occupancy rules, put caps on fees, and between 2018 and 2023, ADU construction jumped 7-fold.
7 times.
Yeah, so it shows that if you do remove those local barriers, the supply can respond pretty dramatically. Financing helps, but zoning is key.
Okay, that's really useful context. So moving from the big picture housing stuff to something maybe more immediate for listeners, personal credit. What are the options if your credit isn't great or if you're just starting out?
Good question. There are basically 2 main paths. You've got unsecured cards and cord. These don't need a deposit if you qualify. Something like the Capital One Platinum is an example. It often has no annual fee and might let you upgrade later.
Okay.
Then there are secured cards. These do require a refundable deposit, but they're actually really good for building or rebuilding credit because the limit is secured by your cash.
Right, less risk for the bank.
Exactly. And now there are even newer options, like the Peddler 2 card. It's interesting because it might approve you even with no credit history at all. They look at your banking activity instead.
Ah, using different data points. That's smart.
Yeah, trying to open up access.
And the key takeaway here really is the long game, right? Building that credit over time.
Absolutely. It comes down to the basics. Making payments on time, every time, and trying to keep your credit utilization low, meaning don't max out your cards.
And there are tools, too, like Experian Boost. That can help a bit.
Yeah, things like Experian Boost can sometimes help by letting you add things like utility bills or streaming service payments to your credit file, potentially giving you a little bump.
Okay. Now, shifting from sort of immediate finances to a much bigger, longer-term worry, Social Security. There's some new analysis out.
Yes,
That.
and it's pretty sobering. The Committee for a Responsible Federal Budget, the CRFB, put out a new projection. They're saying the Social Security Trust Fund,
Oh.
well, it's on track to run out of reserves by late 2032.
2032, that's not that far away. What happens then?
If nothing changes before then, it triggers an automatic, across-the-board benefit cut. They estimate about 24% for everyone receiving benefits.
A 24% cut for 62 million people.
That's the projection, yes.
Wow. Can you put that in real terms? Like, what does that mean for a couple retiring around then?
Sure. They calculated that for a typical dual-income couple, medium earners, retiring in 2033, that 24% cut could mean about $18,100 less in benefits per year.
$18,000 a year. That's a huge hit.
It's significant. And the projections show the cuts would actually get deeper over time. The core issue is demographics, really. We have an aging population.
Fewer workers paying in for each retiree drawing benefits.
Exactly. The worker-to-retiree ratio has dropped a lot since, the 1950s, so the current system just isn't funded sustainably for the long haul without some kind of reform.
Okay, a lot to think about there. Let's pivot now to the corporate world. Some big names making headlines. Let's kick off with Intel. How are they doing?
Well, Intel's latest earnings for Q2 2025 were a mixed bag. Revenue actually beat expectations, came in at $12.86 billion.
Okay, that sounds good.
But they reported a pretty big net loss, $2.9 billion, mostly due to some major restructuring they're doing.
$2.9 billion loss. Even with restructuring, that's a lot. So this new CEO, Lip-Bu Tan, he's making some aggressive moves. Is this strategy resonating, or are people worried about the cuts?
Oh, it's very aggressive. Tan's plan is to slash operating expenses by $17 billion next year, 2025.
$17 billion.
Yeah, and cutting 15% of the workforce. He basically announced no more blank checks for investments.
Wow. So where are the cuts happening?
They're pretty specific, canceling planned factory projects, fabs in Germany and Poland, consolidating testing and assembly work into Vietnam and Malaysia, even slowing down construction on that big new factory complex in Ohio.
Really hitting the brakes on expansion.
Seems like it. And Tan himself is apparently going to personally review every single chip design. It signals a huge shift towards really tight cost control, prioritizing getting back to profit, even if it means scaling back ambitions for now.
Okay, so Intel is cutting back hard. But that seems to contrast with what other tech giants are doing, especially around AI.
Absolutely. It's a really interesting contrast. While Intel's pulling back, Google's parent company, Alphabet, just boosted its spending forecast for 2025, its capital expenditure, up to $85 billion.
$85 billion, that's massive, mostly for AI.
Yeah, a huge chunk of that is earmarked for AI infrastructure, servers, data centers, all that.
So why the difference? Is it just strategy or something else?
Well, there might be a policy angle here, too. There are some new tax provisions specifically around how companies can deduct R&D costs faster, something Congress recently extended.
Ah, accelerated depreciation.
Exactly. That might be giving big players like Alphabet, who have huge profits, more flexibility, even an incentive to pour money into AI right now. It kind of subsidizes those massive investments. Shows how tax policy can really shape these tech races.
Fascinating. Okay, speaking of market dynamics, meme stocks. Are they back? I saw American Eagle shot up because of a denim ad.
Yeah, American Eagle jumped over 4%, apparently tied to a new campaign with Sydney Sweeney. So you are seeing that kind of retail investor buzz again.
Is it like GameStop all over again? Meme stock mania 2.0?
Well, yes and no. There's definitely buzz, but there's a key difference this time. Remember with GameStop, the cost to borrow shares to bet against the stock short selling went through the roof.
Right, the short squeeze.
Exactly. We're not really seeing that extreme squeezy quality with these current meme stocks.
Yeah.
Lending costs aren't soaring in the same way. So yes, there's retail enthusiasm driving names like American Eagle, GoPro, even Krispy Kreme.
Krispy Kreme. Okay.
Yeah, they're in the mix too. But it doesn't seem to have that same intense, forced buying pressure from short sellers getting squeezed out. At least not yet.
Got it. So, similar vibe, different mechanics maybe.
Yeah.
Now, what about Tesla? They've been on a bit of a roller coaster.
Yeah, rough ride for Tesla lately. The stock dropped 8% after their Q2 auto sales numbers came in weak. It's down about 25% just this year.
Coach, but wasn't there something else going on with them? Something about Bitcoin?
Ah, yes. This is interesting. Turns out Tesla sold off about 75% of its Bitcoin holdings back in mid-2022.
When the crypto market was crashing.
Exactly. Might have seemed smart at the time, cut their losses.
Wow.
But Bitcoin is now trading above $119,000. Yeah, it's up 80% in the past year. So by selling when they did, Tesla missed out on potentially billions in gains. Hindsight is 20/20, of course, but it highlights the volatility and the opportunity cost in crypto.
Definitely a missed opportunity there. Okay, any good news in the corporate world?
Well, Deckers, they make Hoka running shoes and Ugg boots. They seem to be defying the uncertainty.
Oh, yeah.
Their shares jumped 15%. They beat their Q1 estimates and gave strong guidance for Q2. This was notable because earlier they'd actually pulled back on giving a full-year forecast because of worries about potential tariffs.
So strong consumer demand for comfy shoes, it seems.
Apparently so, even in a tricky retail climate.
Okay, but then on the flip side of retail, Rite Aid
Yeah.
still struggling.
Yeah, unfortunately. The pharmacy chain is closing another 114 stores. This comes after they've already filed for bankruptcy twice in less than 2 years.
Wow, another 114. Where are these closures mostly happening?
A lot are concentrated in a few states. Pennsylvania, California, New York, and New Jersey seem to be hit hardest this round.
And this isn't just a Rite Aid problem, is it? It feels like part of a bigger shift.
It really is. You saw this huge expansion of pharmacy footprints across the industry,
Yeah.
maybe faster than was really needed. For Rite Aid specifically, that's been made much worse by their huge debt load, sales that weren't growing,
Yep.
and also hundreds of lawsuits related to the opioid crisis.
Right, a perfect storm, really. A tough environment for those traditional chains.
Definitely.
Okay, let's zoom in now. Look at some stories that touch more on daily life, societal shifts, maybe human connection.
Sounds good. Where do we start?
Well, first, something really quite stark. A new study from AARP, it says 63 million Americans are unpaid family caregivers.
63 million. That's huge.
It's staggering. And it's a 45% jump in just 10 years. And get this, most of them get zero formal training for what they're doing.
Wow.
Think about someone like the study mentioned Alma Valencia. She had to quit her job to care for her mom who has dementia. This isn't just a statistic, it's a massive, often hidden burden, isn't it?
Absolutely. It highlights this enormous, you could almost say invisible, stress on millions of families and on our society as a whole. These caregivers are doing incredibly vital work.
Often at great personal cost, financial, emotional.
Exactly. Sacrificing careers, savings, their own well-being.
Yeah.
And yet, as you said, they're largely unsupported, untrained. It really points to a massive need for better infrastructure, things like respite care, financial help, actual training, especially as the population keeps aging.
Yeah, a critical issue. Okay, something different now. Uber. They rolled out a new feature.
Yes, it's called Women's Preferences. In a few U.S. cities to start L.A., San Francisco, Detroit.
And what does it do?
It allows riders and drivers who identify as women to choose to be matched only with other women for their trips.
Interesting. Why now? What prompted this?
Well, Uber says it came directly from feedback. Women, both riders and drivers, told them they wanted this option, largely due to safety concerns.
Right, there have been issues with assaults in the past.
Exactly. And this isn't actually brand new globally. They've apparently piloted this successfully in about 40 other countries since 2019, so now they're bringing it to the U.S. It's a concrete response to those safety concerns.
Okay. Now, for something a bit lighter, but maybe says something profound, Venus Williams, tennis legend, earned millions.
Yeah.
She joked that she came back to pro tennis after a long break, purely for the insurance. Serious.
Apparently. Now, obviously, likely said with humor, but...
But it still makes a point, doesn't it? It's kind of brilliant. It just highlights how crucial health coverage is and how complicated accessing it can be, even if you're Venus Williams with $42 million in career earnings.
Right. It's not always straightforward. Even for the super wealthy, sometimes you need that job-based plan.
It really underscores that healthcare access is this universal challenge, regardless of your bank account.
Yeah. And sticking with health, but maybe the other extreme. We keep hearing about the quest for longevity, right? Extending human lifespan. People like Dr. Aubrey de Grey. Ah, yes, the godfather of longevity. That whole field is fascinating. The science, the ethics. It's definitely a space to watch, always pushing boundaries.
Indeed. Okay, one more interesting item from the sort of daily life category, beef.
Beef? What about it?
Well, we have this massive cattle shortage, right? Worst in over 70 years, inventory's the lowest since 1951.
Right. And prices are way up. Ground beef hit a record, what, $6.12 a pound in July, highest since 1984 inflation adjusted.
Exactly. So logic would say demand should be dropping, right? People should be switching to chicken or something.
You'd think so, but
But apparently, U.S. consumer demand for beef is at a 20-year high.
get out. Seriously, how does that work? Record prices, lowest supply in decades, and people are buying more.
That's the anomaly. How do you explain that?
Wow. Well, I mean, part of it must be deeply ingrained cultural preference, right? But for a lot of people, beef is just beef. It's the centerpiece, the staple they're willing to pay more for.
Maybe substitutes aren't cutting it for them.
Could be. Or maybe there's even a bit of a, luxury effect for those who can afford it. It's hard to say for sure, but it definitely shows how stubborn some consumer habits can be, even when the economics scream otherwise.
Truly fascinating. Okay, let's shift one last time to the political arena, power dynamics, global relations, making news.
Right. And first up, a pretty unusual event. President Trump actually went over to the Federal Reserve Building.
Physically went there to pressure Powell on rates.
Seems that way. It's certainly escalating his campaign, urging Fed Chair Jerome Powell to lower interest rates. It's definitely not standard procedure for a president to visit the Fed like that.
And didn't they even argue publicly about, renovation costs?
Yeah, that was odd. Trump claimed the Fed headquarters renovation cost $3.1 billion, and Powell disputed the figure. It just added to the tension.
And now there's a lawsuit involved, not directly about the visit, but about the Fed.
Correct. An investment firm, Azoria Capital, is suing Powell. They're alleging violations of the government and the Sunshine Act.
Okay, what's the argument?
They're arguing that the Fed's big policy meetings, the FOMC meetings, shouldn't be held behind closed doors. They want real-time transparency to assess risks, and are even raising concerns about, quote, improper political motives, possibly influencing Fed decisions.
So pushing for more openness, potentially fueled by this political pressure context.
It seems that way. The lawsuit kind of taps into that broader scrutiny of the Fed's independence and decision-making process.
And Trump's own view on Powell seems to have evolved. He was talking about firing him before, but now.
Yeah, his stance has shifted. He previously mused about firing him, but now he's saying it's highly unlikely, unless there was, fraud. He apparently now believes Powell will do the right thing, whatever that means in this context. Still tense, but maybe less overtly hostile for now.
Okay. Now, staying in the political and economic realm, trade deals. Japan?
Yes, there's a new trade deal with Japan. Key part is Japan agreed to accept a 15% tariff on cars they export to the U.S.
Okay, 15%. But isn't that controversial? Because U.S. car companies face a higher tariff, like 25%, on cars they make in Canada or Mexico and bring into the U.S.
That's exactly the point of contention. It looks like it gives Japanese automakers an advantage over cars built within North America by the Detroit companies.
So how is that being spun? Commerce Secretary Lutnick said U.S. auto CEOs are cool with it. Does that sound right?
Well, Lutnick claims they are, and he's pushing the narrative that this encourages more manufacturing in the U.S. itself, which aligns with the administration's goals.
So incentivizing Japanese companies to build here, maybe?
That seems to be the logic. Whether the U.S. CEOs are truly cool with a potential disadvantage for their existing Canadian and Mexican plants, or just sort of accepting the political reality, is hard to say. It's definitely a complex play in trade policy.
Okay, and broadening the view even further internationally. France made a big announcement regarding Palestine.
Yes, quite significant. French President Emmanuel Macron announced that France will officially recognize Palestine as a state. They plan to formalize it at the UN General Assembly in September.
Wow, France. That's a major European power taking that step. What's the timing? Why now?
The context seems to be what Macron called snowballing global anger over people starving in Gaza. There's clearly growing frustration in Paris and elsewhere with how Israel is conducting the war.
And what's the impact of France doing this?
It's pretty significant. France is the largest, arguably most powerful European country to recognize Palestine so far. They join over 140 other countries globally that already do.
So that adds considerable weight.
Exactly. It adds major diplomatic weight and could potentially encourage other key European nations who've maybe been hesitant to follow suit. It definitely increases the diplomatic pressure on Israel regarding the Palestinian statehood question.
Okay, what a ride. We've covered so much ground today. From, the nitty-gritty of mortgage rates and ADUs to Intel's huge cuts, meme stocks, all the way to family caregivers and global diplomacy.
It really shows how interconnected everything is, doesn't it?
It really does.
So maybe the final thought for you listening is this. How do all these threads we pull together The demand for transparency at the Fed, the way we're rethinking what home even means, how pop culture can actually move markets.
Yeah.
How does that shape your view of the world? And maybe how does it influence the choices you make?
Yeah. Which of these insights really stuck with you? What sparked more questions? Something to chew on.